I would like to take the opportunity first to thank the Maslow Wealth Advisors team for inviting me here today to chat with y'all about this very important topic. It's something that, she mentioned that they see. We are also seeing an abundance of it as we work on tax compliance, tax planning, and helping individuals move to other countries if that's what their choice is. So I believe that the path to accomplishing this planning successfully is different for everybody. And the reason behind that is because everybody has things that are important to them. And that determination of importance helps them figure out what their plan is, right? So you can go ahead and go to the next slide. Our attorneys make us put this in here. In your packet, you're going to see that there is a Beyond Borders checklist that the Maslow team has graciously put together, outlining key considerations for helping you develop your plan and execute it. Okay? The agenda we have in front of us today is going to cover just a very small amount of those checklist items, right? We're going to talk specifically a lot about tax stuff, and I hope that my stories are good enough to keep you guys engaged, because I know sometimes tax stuff is a little boring. I get really excited, but not everybody does. Understandable. We're going to start out by just looking at some general considerations, understanding some general topics, how taxpayers are classified, because it's really important. That's the foundation for us to help answer questions like, what happens if we own real estate? What if we have, let's go back one slide. What if we have entities in foreign countries? What does it look like if I have income there? Investment accounts. That foundation helps us kind of answer those things, along with things like estate tax and double taxation. How do we get around that? Now you can go ahead and go to the next slide. Sorry about that. So why is planning for international lifestyle important? I think that I would argue that it's not only important, but it's essential. Because if you don't do it, what I have seen, my experience when I have taxpayers come to me that are already in another country and they're dealing with some of these issues unbeknownst to what we're going to talk about, some of the potholes today that are out there. What happens is it causes a lot of frustration, stress, and probably a lot of money if we don't do things the right way, okay? I suspect we've all had instances where if we would have just planned, it would have been a whole lot easier, right? If we plan and pivot, that's a whole lot easier than dealing with a situation after the fact that didn't go well where we didn't plan, right? Before we dig into the materials too, I want to make sure that we talk about the fact that we're going to cover a lot of things that are U.S. tax related. That's on purpose. A CPA I can't advise you on what to do in Canada or Mexico for your taxes because I'm not certified there. But the good thing is there's people like me all over the world, right? So we're going to talk a little bit about making sure that you've got the right team here in the U.S. and then also abroad where you're thinking about living. Let me just ask the question. I had a chance to talk to a few of you. I maybe know a little bit about your particular situations, but just raise a hands. Who has actually, gone down the process of looking into a specific country to potentially move to? Okay, we've got a couple, 3. The rest of you, are you kind of in the initial process of just starting it? Is it intriguing to you? Do you have friends maybe that have done this? Is anybody willing to share? Go ahead.
We were interested in San Miguel in Mexico,
Okay.
Montevideo in Uruguay, and south of Florida.
Okay.
So
Very diverse.
a variety.
Okay. Okay. And so have you just started the process of kind of looking at those locations?
My first obstacle is convincing my wife.
Okay. That is not that uncommon, to be honest with you. That's fantastic. All right, so let's go ahead and go to the next slide. we're going to start talking about the foundational piece here. And so what this slide has on it is the legal status of individuals in the U.S. And I believe these are all also in your handout in case that's a little hard to read. I want to start out by just kind of talking about the U.S. citizen. I mean, we probably all know these things, but I don't want to make any assumptions. That gets me in trouble. So, you know, a U.S. citizen is an individual who has acquired citizenship either through birth or through the naturalization process, right? So they can live here, they work here, they can get a passport, and they are also taxed on their worldwide income. Some of you who have started the process of looking into moving abroad, this is probably a topic that has come up as you're doing your research, right? So what does that mean? I'm taxed on my worldwide income. We'll get to that a little bit later. The next one here is just a green card holder. And so essentially what that is, it's a non-citizen, right? That does not have, they haven't gone through the naturalization process yet. They can live and work here on a permanent basis unless they decide they don't want to anymore. They give up their green card. Or if for some reason the government comes in and revokes the green card. Again, they are also taxed on their worldwide income, right? Becoming naturalized simply means we're going through a legal process to become a U.S. citizen, right? So it makes sense that if we're naturalized, we're a U.S. citizen, we're taxed on our global income, right? So I think everybody has a pen. I want you to write something down on the piece of paper that you have. Let me know when you're ready. Anywhere. Yep. If you want to put it on this general considerations page, that might be a good place to do that. Okay, U.S. citizens are always considered U.S. tax residents. This is a general rule, right? The tax law has all kinds of general rules and then exceptions. This is a general rule. And this is regardless of where they live. Okay? A U.S. citizen is a tax resident of the United States, taxed on worldwide income, no matter where they live. Okay? There may be instances where we have dual citizenship, and there might be a treaty that steps in and says, no, because you're spending time here and there, we're going to count days and figure out where you really are a tax resident. But the general rule is U.S. citizen, taxed on worldwide income, regardless of where we live. Okay? So that's going to be really important as we go through the rest of the discussion today. Go ahead and go to the next slide. So within the tax code, there's terminology that they refer to as an alien. I don't like the word, but that's just what we're stuck with, okay? It's simply a term to mean somebody who is not a U.S. citizen, okay? So if we have somebody come into the United States, they may be here on a work visa, etc. They may be considered a resident alien based on a few tests. And I think this slide is important to us. I know you're not necessarily individuals coming into the U.S. trying to figure out what your classification is. But other countries have something very similar to this, right? Where they count days to help you figure out when do I start owing tax in that country. So we're going to go through what the rules are on the U.S. side so that at least you can be familiar with some of the terminology that they might use. So meeting the green card test simply just means that they have a green card. It's pretty straightforward. The substantial presence test is based on the number of days of physical presence in the United States. And this is the one that we see in a lot of countries to determine your status. Essentially, These are treated just like U.S. citizens for tax purposes from the standpoint that they're taxed on their worldwide income and they file a 1040. Okay? If we have a non-resident, so an example of this would be somebody who's investing in a U.S. partnership. Okay? They are not a resident of the United States. They're just investing here. But they have income that's going to be sourced in the United States. So they have to get an identification number and file a tax return. That form is Form 1040-NR for non-resident. Kind of makes sense. There are some specific rules about withholding if somebody is considered to be a non-resident alien. So again, this applies in many other countries as well, where they say, okay, if we're going to pay interest and dividends out to somebody who is not a U.S. taxpayer, we're gonna make you withhold taxes at the payer level. So instead of the U.S. government having to go track down non-resident aliens in another jurisdiction, it's very difficult. So what they do is they put the onus on a business or an individual to withhold those taxes and remit them on behalf of the person they're sending the interest or dividends to. Okay? Other countries do something very similar. We'll talk about why that's important later when we're discussing the tax treaties and potential foreign tax credits. All right, so I have a true and false question. I forgot to mention this at the beginning. I'm going to ask you guys questions. I also want you to, if there's something that I'm talking about and you've got a question related to it, please stop me. Let's talk about it as we go, so don't feel bad about raising your hand. But my question to you is, true or false? As a general rule, a U.S. citizen is taxed on worldwide income regardless of where they live. True. You guys pass. A's all the way around. It's going to be really important. You guys are going to be so tired of that question by the time we get done today. Okay. Go ahead and go to the next slide. Yes?
No ways to mitigate, no workaround around it,
Around worldwide income?
paying tax.
Yes, there are a lot of ways around paying tax. Just like there, I can guarantee that you're going to get a refund. I'm going to tell you to make a really big tax payment so that it shows up as a refund on your tax return. No, there are ways. The nuance that you're going to see as we talk about things today, it's very fact specific, right? So I was talking to the gentleman over here just a little bit about what happens if I have investments in other countries, or if I have them here, and can I find another country that I'm not going to pay as much tax on as I am here, right? It's such a facts and circumstance-based thing that a lot of time, on the front side, when I'm speaking to a new client or a client who's come to me and said, hey, I'm interested in moving overseas and this is the country I'm considering, we really got to get down to the facts of, when are you thinking about do it? Is it husband and wife? Is it a country that you're dual status in? Like, there are so many things that go into it, but there are some avenues in the tax code, like foreign tax credits, as an example. So if I'm taxed on income that is coming from another country, I'm getting taxed in that country as well because I'm living there. Foreign tax credits can step in if we have a treaty with that country. And basically what it does, it's not an exact dollar for dollar, right? What we see is it's usually about 80 to 90% efficient, meaning if I have to include that income on my U.S. tax return, those foreign taxes that I paid, I get a credit on my U.S. tax return for about 80 to 90% of those taxes that I paid in the other country. So there are ways to definitely help mitigate that, but you got to do it the right way. Yeah.
What if you're retired and you have no income? What kind of income happens with another?
So we're going to get to that.
Okay.
You're not a plant, but that is definitely something we're talking about later. I love the question. Yes.
Worldwide income question. So
Yeah.
a dual citizen
Yeah.
is making, let's say, income in another country, Ireland.
Uh-huh.
How does the U.S. know you're making?
So the IRS carries they have what I call the carrot and the stick, okay? And the stick in this case is they know because we self-report, right? Honor system. However, if you don't follow the honor system, the carrot, they are going to hit you with the stick. And what we have found is the US and other countries are trying to communicate with each other on certain tax matters. We're not there yet where there's like an international 1099 reporting or anything like that. But the reality is, if you don't file some of these forms, the penalties are so big that most of the time it's better just let's fill out the forms we need to. I know it's a pain, I know it costs money to do that, but let's just make sure that we're in compliance and figure out some of the things that we can do to help mitigate the dual taxation or the higher tax rate in the US. Okay? All right. Yeah. Yeah.
Perhaps maybe you can answer this later, but I'd like to understand the strategy when it comes to trusts. Is that a way around it?
We are definitely going to talk about that. Okay. So when we talk about expatriating, the full legal definition is what you see on the slide, up here in your book. It is a U.S. citizen who is renouncing their citizenship. Okay. So it's not just simply somebody who is a U.S. citizen who is living abroad, hopping around countries every 3 months, etc. That is not the legal definition nor the tax definition of an expatriate. Essentially, what you're doing here is you're shedding the responsibility of all of the U.S. tax filings on non-U.S. source income. Okay? Remember our non-resident alien a few slides back? If you renounce your citizenship, you're no longer a U.S. citizen and you're living abroad, but you still have a rental property here. That is still U.S. source income. You still have a filing requirement. It's just a 1040 NR instead. But what you get around is not having to deal with forms that require you to disclose ownership in foreign corporations. You're not required to disclose and pay taxes on income that's generated in foreign countries. So that is the benefit of renouncing your U.S. citizenship. Okay? Green card holders can do the same thing. They can walk away from their green card. And both of these are an actual, there's a set process. You don't just leave the country and say, okay, I'm done, right? There's forms that we have to file. And in the case of renouncing your citizenship, had a client do this in Italy last year. And you're a little bit at the whim of the U.S. Embassy in whatever country that you are trying to renounce in. So he had a little bit of a delay, 6 months, because they would not keep the appointment. So he would set an appointment, he would go in, they'd say, oh, sorry, we're full today, all the appointments are getting moved, here's your new date. So that kept happening, fairly regularly. And so when he finally got to the point where he was able to sit down with somebody at the embassy, there's usually at least 2 or 3 conversations you have to have. So imagine this appointment, this kind of kept happening through each stage. So there's an interview, and then on the last day when it's actually happening, you have to swear an oath that you're giving up your U.S. citizenship. You have to sign a piece of paper, and they stamp it with a date. That date is very important because that determines how you're going to pay taxes, not if, but how usually you're going to pay taxes on all of the assets that you have. Worldwide assets. This is a truly an exit tax, right? So this is the U.S. government getting its last bite at the apple of all of your assets that you have, okay? A covered expatriate for tax purposes has a little bit different definition. So this is legal purposes. The other side of the screen is tax purposes. So the one that usually catches people is the net worth of $2 million or more on the expatriation date. So Remember I said that that date that they stamp on that piece of paper is really important. That is the expatriation date, okay? So we have to literally look at all of the assets that you have on the day before that. And we'll talk about why that's important here in a minute. So this taxpayer that renounced his citizenship in Italy last year, we had been working with him for 10 to 12 years. He first came to us because he was selling what he dubbed as his last business. He's never going to do this again, right? So we helped him through the legal process and helped him with tax compliance related to that, getting the biggest take home that he could from that. He maintained, the thing that he was trying to figure out was, what do I do next, right? He had some ideas about what that looks like. He has some family and friends over in Europe, so he was taking a lot of vacations. Vacations, that's important. We're going to talk about that later. The thing that's important here is that he kept having family members in Italy say, well, just give me $10,000. I'll give you ownership, 50% ownership in the company. Give me $10,000 and, let's get this thing started. And he would call me up and he'd say, is that something I should do? What are the implications of that? Well, you'll find out later that that's not necessarily such a good idea, because he's what still? Before he expatriated, what is he? He's a U.S. citizen, and he's taxed on his worldwide income, right? And now, if he's got this foreign corporation, we'll find out in a few minutes, that requires a whole form that's like a tax return inside a tax return. Okay, so that $10,000 is going to sign him up for a whole lot of headache. So part of what our job is to walk clients through those things. Like, let's talk about what you're planning. Kind of going back to the very beginning of everybody's plan is going to be a little different. But let's understand what the impact of that is going to be before you do it. He also set up bank accounts because he was traveling to Italy on a fairly regular basis. And I know there's some kind of head nods in here. So I think some of you probably know that that bank account, if it gets above 10,000 US dollars at any point during the year, you've now got additional filing requirements that you have to do, right? Our lovely F bar that they've now changed into a Form 114. Okay. Let's see if there's anything else. So in this time period, I'm going to use him as an example through some of the next slides. In the years after he sold his business, he acquired some rental properties, some in Texas, some in Florida. And so when he starts talking about getting really serious about moving to Italy on a permanent basis and renouncing his citizenship, we had to really do some planning around that to help mitigate this exit tax that we've been talking about. All right, go ahead. So this slide is telling us how we calculate this exit tax, okay? So remember, the thing that usually gets people, if they're going to renounce their citizenship, to be required to pay the tax, $2 million in net worth. That's not a lot these days if we think about it, right? So this really does pull in a lot of taxpayers as they're exiting. There is a concept in the tax code related to exit tax called mark-to-market. So essentially, we boil it down to, we take all of our assets and we pretend like we sell them at fair market value, right? So the Italian gentleman that I was talking about earlier, he's dual status, by the way. Basically, he had 4 rental properties when we started this conversation about expatriating. And in the planning for him, he looked for opportunities for when the market was going to be good, and he spaced the timing of the sale of those rental properties out so that we could mitigate capital gains tax. So to keep it in the 0 or the 15, or maybe we have a little bit that's in the 20% capital gains tax. So it can be years that you need to kind of develop the plan, right? Any gain that is over $866,000 in 2024, and this does get indexed for inflation. I don't remember what the number is now. Any amount over that, basically you pay tax on it as if you actually sold it. right? So it's a mathematical calculation. We determine what the tax liability would be on the gains. And if you've got different kinds of properties, so you've got some that are capital gain producing, you've got some that are ordinary, we've got to go through that process for each and every asset that you have. And when they say fair market value for property, they want you to actually get an appraisal from a real estate agent. So, yes?
This includes like all of your investment.
Everything. So this would include crypto. Like these are even things like any asset that you have, we have to put it on the sheet and say, okay, what's the fair market value? Determine what the gain is.
How
Yeah.
often does the appraiser need to appraise the properties?
So it's going to be effective the day before you expatriate. So what we would do is we would have the client go to a real estate agent and say, this is the date that we need to have on the appraisal, that it's effective, right? Because that gives us good support. If the IRS were to come back and look at the form and try to challenge the fair market values on there, we want to have the documentation and support for that. I have seen taxpayers, just use property tax values. It's not what I recommend, but I have seen that happen before. Let's see. So with the gentleman I was talking about that moved to Italy, I didn't mention when I talked about all property up here, there are some exceptions, okay? When you think about retirement plans, so we're going to use the example of a SEP IRA. I've got a SEP IRA at the time the day that I expatriate, the day I'm doing the calculation, it has a certain value to it, right? I haven't paid taxes on anything that's in there, right? It's a pre-tax account. That's deferred income. So you'll see in the last bullet point on here, there's something about we got to keep filing this form for deferred income. So you have a choice to make if you decide to renounce your citizenship. And that is with certain retirement accounts, you can make the decision to include the fair market value in your tax return in the year that you exit. Or you can choose to follow the last bullet point on here, which is when you receive a distribution from that retirement account, they will withhold 30% tax each and every time you receive a distribution. Okay? You still have a filing requirement in the US in this situation because you have to file this form. You have to file a 1040 NR that says, I received this amount of distribution from the retirement account. Here's what they withheld. It's strictly paper pushing at this point. There's no additional tax. The 30% covers you. Yes?
So I'm a little confused. Does this only apply to folks who determine they are giving up their U.S. citizenship?
Correct.
Or is this for folks, you had the other one where they could live permanently overseas and were deemed
Yep.
to be an expatriate?
So let's go back to the baseline concept. If I'm still a U.S. citizen, I pay tax on my worldwide income.
Okay.
The only way to get out of that, if I'm currently a U.S. citizen, the only way to get out of that is to renounce my citizenship, and then this tax applies. It's truly an exit tax.
Okay.
Does that answer?
It does.
Okay, you bet. So what we did with this gentleman is we had to run some calculations. He happens, for the 2024 tax year, he happened to have fairly low income because he had some passive losses from some partnerships and things like that, okay? So because of that, we included his SEP IRA in taxable income, and we just, okay, let's see what the tax that he owes on it is, okay? And we took that same thing, that same dollar amount, just the value today, and multiply that by 30%. The difference in tax liability there, it was better for him to accelerate the tax on the distribution, on the account now, and include that in income on his final U.S. tax return than it was for him to pay 30% when it comes out later. Remember too, when it comes out later, it's going to be, we hope, elevated dollar amounts, right? So you're going to pay even more tax than the flat 30% on the current value at some point in the future. Yeah.
So you converted that essentially from an IRA to a Roth?
We did not. Essentially what you do is you make an election on the return, and it says, I'm changing this from deferred income to current income. So he had a desire, I don't want to have to file a tax return ever again in the United States. He was very adamant about it. And the interesting thing is his wife did not expatriate. So his name is still going to be on a return, but it's not going to be his return. So it takes away the filing requirement in the future. It's very interesting, gentlemen. Yes?
Does assets have to stay in the United States, or can you take those assets elsewhere?
You can do whatever you want with them at that point. There are some requirements when you make that election. He had to notify the basically the custodian of that account that he was making this election. So that, you know, the default is if you make a distribution to a non-resident alien, at the point where you're paying the check out, you have to do withholding. So the brokerage house would have been required to withhold 30% tax on that without him notifying them that, look, I've already included this in income. I've moved it out of deferred income and included it currently. So then they just keep that in their records and he gets just the cash distribution. Did that answer the question?
So it doesn't matter if it stays in the United States, you just get your cash distribution.
100%.
You already paid the tax.
That's right. Exactly. Sometimes this tax liability can be very large. There are opportunities to defer the tax, but there's also can be some hefty interest tied to it. So just be aware that if this ends up being the right thing for you, if there ends up being a large tax liability, part of when we look at that would be to say, okay, this much is going to be due right now, this much is next year, etc. So there is the ability to defer, and I think it's an 8-year time period.
Very other person, sorry, this is getting really detailed, but is it all retirement plans, or is it ERISA plans versus IRA plans?
Generally, it's pre-tax accounts. Yeah. So, and I say generally because there are some nuances in that really big code section that's related to this.
Well, just like 401k typically potentially has some different rules than like an IRA.
Correct. Correct. Think tax deferred means it's going to fit in this deferred bucket, and I may want to make that election. All right. Okay, let's go ahead and go to the next one. So I use Joe and Mary here. They're U.S. citizens. They moved to Portugal, but they did not renounce their citizenship. Okay, so everything we have been talking about on the last 2 slides was I'm raising my hand and I'm saying I don't want to be a U.S. citizen anymore. Okay, everything beyond this, we're going to talk about what it means to maintain U.S. citizenship, but maybe live abroad. Okay. We want to use our foundational, go back. No, you're fine. So we want to use the foundational stuff that we learned earlier to help us with some of the questions that we're going to talk about next. What are their ongoing filing requirements, right? So tax accountants are kind of boring and dry. But I thought this joke was kind of funny. It did not come from me. It came from one of my colleagues. Okay, so what is the difference between a vacation and an international lifestyle? Anybody want to take a stab at it? About 47 tax forms and a very patient taxpayer. All right, you can go ahead and go to the next one. Okay, so this is where we start our potholes ahead. We just need to be aware of what's coming up here. So we're going to start out talking a little bit about real estate and the different entities. So I think this part goes well by just walking through the answers to some of these questions, right? So remember, I'm a U.S. citizen, I'm living abroad, and I have income and expenses on a U.S. rental property. Am I going to be taxed on that income?
Yes.
Yes, because we are a U.S. citizen. We're taxed on our worldwide income. Fantastic. You guys are doing great. So Schedule E, we just continue on just like we always have. We get depreciation, we get the normal expenses, nothing changes. We're still filing a 1040, right? What happens if we sell U.S. property while living abroad? It's really kind of the same answer as what we just talked about. Exactly what it would be as if you were living here in the U.S.
Wait, what if it's your primary home? Well, technically, if you're living in.
Man, you guys are asking fantastic question. It's right down here on my slide. Okay, that's a great question. I'm going to get to it. So the primary residence exclusion still applies. So here is a planning opportunity, right? So if I move abroad and I decide to rent what used to be my primary residence, okay, this is going to be like extra bonus points if anybody knows this. How many years do I have to treat it as a rental property and still get my primary residence exclusion?
I know the answer.
Okay, what is it?
3 out of the last 5.
So 2 out of the last 5 I used it as my primary residence. So 3 years is the maximum amount of time that I can use it as a rental property and still get the primary residence exclusion. Now don't play around with those dates so close. I've had some clients get really, really close. Yes?
No, which also means that you can have a rental property for 56 years, come back for 2, and you're good. Right?
You can. Okay, so all of the same rules apply, right? Okay, now we're getting into a little bit dicier territory here. So what if we report, we have a foreign rental property that has income and expenses? Are we taxed on it still? Yes, right? Okay, there are some nuances. There's a few differences. So when we depreciate rental property that is located in the US, we get tax lives of 27.5 years or 39 years, typically, okay? Depending on how we're using it, residence or commercial property. When we have a foreign property, we have to switch to a different methodology for depreciation. It's not a huge difference, but there's something called ADS. It's an alternative depreciation system. Not a big deal, but what I do see with new clients that come to us is sometimes maybe they continue to use the US-based depreciation schedules. And that makes us have to do a change in accounting, which is another tax form. So we're up to like 2 of the 47 I talked about on the joke. Okay, so here's something interesting that some of you may have already run into as well. Some countries require that you not own the property individually if you are not a citizen of that country. So Costa Rica is a great example. They typically want you to set up an entity in their jurisdiction so that if there's any issues there, they have a way to enforce the laws that they have. Kind of makes sense, right? If you're a US taxpayer and you're just visiting Costa Rica, you have a rental property there, it's harder for them to enforce the law. Now, they've got the property, right? So there's a lot that they can do. But the minute you start talking about setting up an entity is the minute you need to call your CPA and say, okay, I think something's changing here and I need to understand what's going on, okay? Most foreign entities by default in the US, so it's a foreign entity, but the US has to look at it and say, what is that entity? The default is generally for it to be a corporation. So corporation for US tax purposes, that's the default. And that's the default if there is limited liability in that entity. All is not lost. We have elections that we can do. There are some things to help mitigate the tax liability or lessen it, okay? But what you're signing yourself up for is a Form 5471. This is a cuss word in the tax profession, okay? This is the tax return inside the tax return that I was talking about earlier. So literally what it requires you to do is, in most cases, this is going to be a closely held company, so you're going to own more than 10%. You're probably going to own more than 50% because it's a rental property that maybe you and your sibling or you and 3 friends. I've got some clients that did that a few years ago. They wanted to buy a property in Costa Rica. They set up the entity. They didn't talk to me about it beforehand. So then we started talking, and we don't do the tax returns for 2 of the other friends. We do now because they didn't want to have to deal with the compliance related to this. This form, if not filed, is a minimum $10,000 penalty. 5471. Yeah. And actually, it can be up to a $20,000 penalty because there's different categories of filers that have to fill this out. Essentially, you're preparing a balance sheet and an income statement for that entity. You're translating it into US dollars. And if it produces income, you're paying taxes on it. Right? These closely held.
What if you inherit a property that's foreign property?
So the first thing to know is that when you inherit anything over $100,000, you have another tax filing form that you have to do, even if it's just informational. So you now own the property. You are responsible for any tax compliance related to it.
It's like having it here.
Well, if it's in a foreign country, we would be treating it like I was just talking about. You'd have a 5471 if you had to own it through an entity. If you owned it individually, the 5471 is not required. So if you have the choice, you would think, okay, from a tax perspective, I want to own it individually. But then the attorney on the other side of the room is going to say, no, 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 we're not doing that, because you have now subjected the rest of your assets to potential liability. Okay? So there's give and take on these things, which is why everybody's plan is a little bit different. Let's see. Foreign residence. So we buy a property in another country, and we're using it as our primary residence. We're still a U.S. citizen, taxed on worldwide income, filing a 1040. Jeez, I am not getting through this fast enough, y'all. We're going to have to do another session. Or maybe I can borrow 5 more minutes. Essentially, the thing to take away from this is that it's treated essentially the same, with the exception of property taxes. Foreign property taxes are not deductible on Schedule A. Joy. Mortgage interest is, so we're good to go there. If I sell foreign real estate, business or personal, this is a surprise to some folks. So if I buy a property in a foreign country, I live there for 2 years, I haven't used the primary residence exclusion in the last 2 years, and I sell that property, I can still get the primary residence exclusion, even though it's a foreign property. That's if I'm using it as my personal residence, okay? If I have a rental property, there is a gotcha buried in the tax law. It's code section 988, nobody wants to know that. But if you purchase the property with a mortgage, you transfer US dollars to foreign currency to buy the property, you get the mortgage in foreign currency, right? Let's say the foreign currency decreases in value compared to the US dollar. So easy example here, think Canada, think Brexit. Those are all great examples, right? Where the exchange rate for those went down compared to the US dollar. So now I sell the property, I've had it for 3 years, and I pay off the mortgage. I'm happy, right? Because my US dollar buys a whole lot more of the foreign currency, and it's not going to cost me as much to pay off that mortgage. IRS says, no, 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 we're not going to play that game. You have to recognize a gain on the exchange. So 988 is an exchange gain or income, and the other really sticky part, it's ordinary income. It's not capital gains. This is above and beyond the actual gain that I might report on the sale of the property. They're computed separately. They're 2 different taxes. Okay, so that's the gotcha you got to watch out for there. Let's see. Yes.
How frequently are people audited before?
I get that question a lot too. I wish I knew the formula so that we could prepare clients for, look, this is what's going to happen. Yeah, I mean, knock on wood, I have not had to go through an audit with a client where we have been dealing with these issues, okay? what we hear from the IRS is, think about where we're at right now with them. They cut their workforce. And the workforce they cut was not the newbies, right? The workforce that decided to retire early are the experienced people who know things. I actually had to walk an IRS agent through how to calculate S corporation basis, and they were auditing the S corporation return. So there is some comfort in that, I guess you could say. But I don't want to rely on that. I want to make sure that our clients are covered, that we're dotting I's and crossing T's. Yeah, but it's a great question. It absolutely is. Yeah.
Competent people in the IRS is not a comfort. No way.
You know, the interesting thing though is if you approach them politely when they, like this particular agent, we got everything we asked for in that audit. There was a very small adjustment. So it's that whole thing of, you know, kindness, right? Honey, yes.
Compliance reasons, please file your taxes.
Yes, 100%. Yeah,
So, you made income off of rental property in a foreign country.
yes,
Paying those taxes, right?
yes.
What if you're dual citizen, you pay double taxes?
Okay, so dual citizen gets very, we go back to this facts and circumstances, because it could be that you may be able to claim a closer connection with the country that you are dual in because you're living there. But what happens is any US property you're still going to pay taxes on, because even if you're a non-resident alien, you're paying taxes on any US sourced income. Does that make sense? There's a lot of treaty stuff that goes into a lot of research to make sure that we're treating that kind of income properly. And it's usually more what we're dealing with is property in the foreign country. That is the harder to figure out, can we exclude it off of the US return? Yes?
So a foreign property that's in your name, not in an entity,
Yes.
that was your primary residence,
Uh-huh.
if you were to sell it within 5 years,
Yep, so you lived in it for 2,
yes,
and you sell it within another 3-year time period, yes. Still qualifies for primary residence exclusion.
so you don't have that extra form and that extra,
So if you're using it as your primary residence, there is no mortgage exchange gain or loss. Only if you're using it for business purposes does that usually, there's an exception that says if this is personal property, I don't have to pay that additional tax on the exchange rate because of the mortgage. All right, let's go ahead and go to the next one. I'm gonna just hit a highlight here. If ever you are getting involved in a foreign company and you're going to own more than 10%, and you're sitting in a room where other people are buying shares in the entity and they are also US citizens, you have to be aware that there is going to be additional filing requirements. Okay, 10% is generally kind of the magic number. We have attribution rules, so the thing to be careful of is if we have husband and wife, we're going to say, okay, the wife owns 5%, the husband owns 5%. Well, we're not at 10, but there's attribution rules that say what the husband owns, the wife owns when it comes to measuring that 10%. Okay. We talked about the 5471. That's what this is related to. How about what? Also, so there's up and down and side-to-side attribution that happens with ownership. And they just changed these rules in the bill that was passed in July. To our best estimation, and there were, I was sitting in a room last Thursday and Friday with about this many people that, come from the caliber of, they oversaw the KPMG International Tax Department for 15 years. They're on some of the regulations comments. So these are really smart people, a lot of them code heads. They're not sure what these new rules mean. There are some ambiguities in there that need to be cleared up with some guidance from the IRS. So, but just kind of use that 10% as a meter. Really, anytime you buy a foreign entity, you should be talking to your CPA, your attorney, and your financial advisor. Okay. Let's switch to income and investments. Was trust on this one? Okay. Somebody asked about foreign trust earlier. Okay. This is another one of those, it may make sense, but you really have to vet it out. Foreign trusts are really complicated because the laws are different that govern what happens with the assets, right? So I'm working right now with a client that has a Belize trust. This trust has a feature to turn on and off whether it's revocable or irrevocable. We do not have anything that looks like that in the US. So you can imagine trying to figure out the tax compliance related to that. The costs of that are going to be enormous. And so that's fine. We can probably figure it out, but it just has to be worth it, right? It's that cost benefit part. So if the trust is going to check the box 9 things out of 10 and tax is the only one that's throwing a clinker into the thing, maybe it's still worth doing. But foreign trusts also have a form called a 3520. If you are the beneficiary of a foreign trust, you're required to file this form with your tax return, even if the foreign trust does not file one. If you fail to file the form, it's a $10,000 penalty. They like that number, 10,000. It's a penalty on a lot of the forms. Okay. So if we're talking about here, as far as just investment accounts, right? I'm taxed on my worldwide income. That includes if I have an investment account here or it's overseas. Okay? The difference is that if I have a foreign investment account, just like a foreign bank account, I now have a new form that's required, 8938. There's values involved in this. Basically, if you have an account that's over $100,000 US, you're going to be filing the form. It's informational. The reason they want you to provide the information, self-reporting, is because if that account has interest or dividends or anything else like it in the account, you have to include that in your income because we got to pay taxes on our worldwide income, right? One thing you do have to watch out for is something called a passive foreign investment company, okay? PFIC. This is a mutual fund, okay? There's a long definition about what qualifies for it. But basically, this is not an operating company that you're investing in. It's based in a foreign country, but it's a mutual fund. How do we know that it's a foreign mutual fund? It's probably traded somewhere. Not always the case. There are privately held funds. The part to remember about this is if I do an investment in one of these PFICs, the default rule is when I get the money out and there's a gain, the IRS assumes that from the day I bought it to the day I get the money out, that I earn that income equally over that time period. That might be 5 years, right? So what they do is they say, well, you know, we don't have sight through to this entity that you're invested in, this fund that you're invested in. So we're going to make it a little harder for you if you decide to do that. You are going to have to pay interest as if that income was earned equally over time. So as if you go back to the first year that you bought it and you pick up, in our example, 1/5 of that income, what would the tax have been? Now you pay interest from that date to this date. And you do that same exercise for every single year. So what ends up happening is you end up paying an effective tax rate sometimes 40, 50%. So again, it's that, is it worth it? Now, there are some foreign mutual funds that have gotten really smart. How am I doing on time?
It's 6:05-ish.
Okay. Do you guys mind if I spend 10 more minutes? Okay. Okay, perfect. So some of these companies, closely held mutual funds, have gotten smart in that they're basically going out and talking to folks that are US citizens considering moving to their country, right? Some of you who have done some research into potentially moving to another country or becoming a citizen there, you know that a lot of countries have a requirement to invest in their country, right? Australia is the biggest ticket one going right now. I've got 2 clients, and it's somewhere between $7 and $10 million of investable assets that you have to have in their accounts, okay? So you're gonna have a mutual fund in there in that kind of a situation. The good news is if they are really catering towards US citizens that are considering either expatriating or just living there long term and investing there, there's some information that they can provide to you that allows you to make an election on your tax return, okay? If they will disclose to you certain information about income and distributions, you can check a box that says, and I won't get into QEF, it's a QEF election, on another tax form, and that tax form is 8621, okay? In case you're keeping track, I think we're up to 6 now of the 47 forms. You make the election, and what it does is it takes you out of that bad default taxing scheme. Instead, what you do is you pay taxes on the income that is reported to you. So think of it like kind of like a K-1 that we have here, right? It's giving you the information you need to be able to determine how much is taxable to you this year, okay? That's a pretty good deal. If you have a mutual fund that is traded on a market, and they're not going to provide you this information, there's yet one additional election that you can make. It's not as good as QEF, but it's still pretty good. And it's called the mark-to-market. So basically at the end of every year, I look at what the value of that investment is. And if the value has gone up, I pay taxes on the increase. Right now, today. That can cause some pretty big swings if you think about what if the market was on an up at the very end of the year and then it went down, right? It's literally on the last day of the year. There's no other date that we can look at, okay? So there's some, yes?
Will it allow you to take losses if it is down?
So kind of, okay? So we start out, let's say in year 1, it goes up in value. And so it went up in US dollars, $10,000. So I picked up income in year 1 on my tax return, $10,000. Because I had income, that's now basis to me. My basis in that investment goes up, okay? So now we look at the next year, it's down 5. So I had a loss of 5 this year. I should get to take that on my return, right? No. So you carry it forward. There actually is the ability, again, with some additional computation and disclosure that you can help offset that $5,000 and use it because we included $10,000 of income in the prior year, okay? If we're not able to take the $5,000 lost this year, it's not lost, it's just carried over. So if we go back up and we have a $2,500 gain next year, we can use that $5,000 to negate that $2,500.
How far can you carry this forward?
I have clients that have, the Australian couple that I was talking about, we've been helping them with these kind of calculations for about 8 years.
So there's no limit?
No. As long as you hold the asset. Now, if you sell the asset, we compute gain and all of that stuff just like we normally would. If there's loss carryover, you get to take it at that point, right? Because you're divesting the investment. Oh, I forgot to say too, with the bad taxing for these PFICs, that's considered ordinary income. You do not get the benefit of capital gains, right? It's like we're getting it from both sides, right? Whereas if we're able to make these other 2 elections, we can get capital gain treatment on some of that. Okay. Let's go ahead and go to the next one. So retirement accounts was a question that somebody had. Can we still contribute to a U.S. retirement plan? The answer is maybe. Okay. So remember that even right now, if we want to contribute to a retirement plan like an IRA, we have to have compensation income first, right? So we've either got wages or we've got 1099 income or something that is earned income. It's not dividends and interest and capital gains, but it's actually something I'm getting paid for something I'm doing, right? Those limits still apply. If for a 401k, you have to have US source income. And usually where I see this is we have, multinational company that sends some of their employees overseas for a couple of years, right? They're still going to be able to contribute to their retirement plan.
Do they still get to contribute to their IRA?
Only if they actually have compensation that's taxable on their return. I know we're not going to have time to get into it, but there's something called a foreign earned income exclusion, which basically says if I'm doing services in another country and I've lived there long enough, there's some very strict rules about number of days. You're going to get very good at counting days if you're moving around in different countries. I'm just saying, you're going to want to keep a log. But essentially what happens is, let's say I had $10,000 worth of income that I earned when I was in Italy. And because of the foreign earned income exclusion, I don't have to actually pay US taxes on that. Then I don't actually have any taxable compensation income on my return. Therefore, I cannot put money into an IRA. Make sense? Lots of moving pieces when it comes to this, and we have to run calculations different ways. What's better, foreign tax credit, foreign earned income exclusion? Let's see. So RMDs and distributions from retirement, US retirement accounts, if you are still a citizen, it's taxed the same way. There's no difference. Can you receive Social Security? Generally, yes. However, don't move to Cuba or North Korea because they won't send you the check. They won't. They'll hold it for you, and if you move to somewhere else, they will pay you in full, but they will not send it there. If you're a non-resident alien, so think of the taxpayer who expatriated, you can still receive your Social Security benefits from when you were living and working here. There's nothing wrong with that. They're going to withhold 30% tax. You need to file an income tax return so they don't send you a nasty gram, okay? How does the IRS treat foreign retirement plan distributions? Oh gosh. So this is another one of those, really a lot of smart people in the room. And there are so many things so many facts that come into determining the answer to this question. Let's take an Australian superannuation fund, okay? Different people contribute to your superannuation fund. It might be your employer, it might be the government, it might be you. So again, this doesn't look like anything that we specifically have here, mainly because of that government piece, right? Mexico has something similar, where they're required to put money into a retirement account for employees. So the first thing we have to do is figure out, okay, is this a dog or a cat for US tax purposes? And usually a tax attorney gets involved, because if there's a combination, like in Australia, if there's a combination of funds going into that account, it's a mixture. So when I take the money out, I may get some cost basis. So think of a non-deductible IRA. If anybody's ever had one of those, you contributed to an IRA, but you didn't get to take the tax deduction for it. You have basis in that IRA. When you take the money out, you've got some basis that you can use. It's not all taxable. So the short answer to this one is, I'm going to go back to an attorney that I had for a professor in college, and it depends. Okay, so it's literally, yes. That was the reaction the whole class had after we figured out, what did she just say? All right. Rollovers, you can still do rollovers. So if you have a traditional IRA and you want to roll it over into a Roth, you can still do that. Same rules apply as if you're living here. Doesn't matter whether I'm living abroad for 3 months or 6 months or a year. I'm still a US citizen. I'm still taxed on my worldwide income. Roth IRA distributions can get tricky because if you are living abroad, and you're living in a country for long enough and you have established a tax residency in that country. So you can be a US citizen, taxed on your worldwide income, living overseas, and be considered a tax resident of another country as well, right? So the tax treaty steps in and tries to help out when situations like that happen. But there are a lot of countries that don't have something that looks like a Roth. They just don't have it. There's not some account that can grow tax-free while it's growing and take the money out tax-free. They just don't have it. So where it's silent and they're taxing you also on some kind of worldwide income concept, you're going to get stuck paying taxes on that in that foreign country. Which is why it's really important to make sure that you've got a CPA, attorney, immigration, tax, financial advisor, all of those things you're probably going to want wherever you're thinking you're going to eventually land. Yes?
Even if it's like a US Roth?
Yes. Because what's the difference here is that I'm not going to be taxed on my US tax return on it. But if I have established tax residency in a foreign country, because my number of days, a lot of them have a 183 days. It's not magic how they got the number, right? It's half of the year. If you live there for over half of the year, some of them want to start clawing into the income that you receive. Now, thankfully, I shouldn't say most, there are many foreign jurisdictions that don't take the approach that the IRS does and say that you're taxed on your worldwide income, right? So you may end up only having to pay taxes on what you collect while you're there. But if you take a Roth distribution and you're a resident of a country that taxes income, they're going to say that's a retirement plan distribution and you got to pay taxes on that because they don't have anything that looks like a Roth. So that's a cautionary, that's something you just have to ask. And it changes country to country.
And the good news is they're even more incompetent than the IRS.
Sometimes.
So Melinda, when you said that scenario, it's regardless whether you get your income from your U.S. assets or the income that's generated by just living in the country.
Correct.
It's the same.
It could be, yes, depending on the circumstances. You guys are going to get really tired of my summary at the end here. Okay, so let's talk about a couple of other considerations here. How are we doing on time, even with my extra 10? Okay, so just some very important highlights here. I get a lot of questions on Medicare. I am not a Medicare expert, but I do have some folks that do this Medicare consulting for a living. And so I just want to highlight a couple of things. It doesn't generally cover medical care costs outside the US. So you want to ask the question of how frequently are you going to be back to the US? Do you want to pay extra for the extra pieces of Medicare? Or is just the free version sufficient enough to cover you if you come back and something happens? Most of us, the answer to that is no, it's not enough. But what options are available to you abroad? It's becoming more and more popular for them to other countries to issue insurance to US citizens while they're living in their country. A lot of times what they want to see is some kind of a lease that is signed that basically guarantees you've got some kind of a foothold there in order to be able to get it. Medications is another really big thing, y'all. I have a client and friend that they were in the process of moving to Portugal. They did all of their paperwork. They were literally ready to get on the airplane next week, like within the next week. And they find out that some of their household items weren't going to ship in the right amount of time. They had to stick around to make sure that they were meeting with the company that was going to ship their goods. Turns out that that was actually a good, happy kind of accident. So anybody who's a fan of Bob Ross, happy accidents. So what ended up happening is the leadership in Portugal completely changed. And so think of this like sweeping tax law changes. they find out about this through their immigration attorney, and essentially their tax bill in Portugal was going to go up by almost $40,000 because what they're doing is adding, as I understand it, they're adding some additional taxes for U.S. citizens that are becoming Portuguese. So they're adding some kind of entry taxes, basically. And so we don't know where it's actually going to land. That's just assumption based on what those individuals campaigned on. But what they decided, okay, we're not going to Portugal. They're going to Costa Rica, which is where they are right now. They're going to spend a year in Costa Rica and then decide whether they want to go to Portugal or not later. So, but the interesting thing here is the counting of the days, okay? So they're going to be in Costa Rica. Their plan is to be there for a whole year. They can't stay in Costa Rica that whole time because that's not a vacation anymore. So what they have to do is I think it's 3 months, they have to go out of the country for 24 hours and come back. Right? So you're going to get really good at counting your days. All right. Other considerations here. Let's go ahead and go to the next slide.
Melinda, I got a question about the counting the days,
Yes.
and I'll forget if I don't know.
That's okay.
So the 183, what's a generally acceptable way of documenting that?
So because they're not stamping our passports, it's harder to do that. What I see our clients doing is they literally keep track of their airline tickets. They put them in a folder just like they do any other tax receipt, and then they're keeping an Excel spreadsheet to track, okay, on this day, this is where I need to be counted. And just so something to consider, the 183 days for somebody entering the US, there's a 3-year look back period. So you count 100% of the days in the current year, 2/3 of the days in the year before, and 1/3 of the days of the year before that. Other countries have a similar look back. So you really got to kind of dig in and make sure you know what the rule is of when you need to leave so that you don't get subject to tax in the country. Okay.
This is complicated.
It is complicated. You stole one of my takeaways.
Does the last slide say stay put?
No, but move forward with a plan and caution. That's what we're going to get to. So real quick, estate taxes, you're still a U.S. citizen. You're still subject to estate taxes. You're still subject to gift tax rules. Just make sure that you don't think that because I'm living abroad, I don't have to worry about that piece of it. Let's see. So let's talk about double taxation. I've got just one example to give to you. So I have a client who is a U.S. citizen, but mom and dad were born and live in Japan. Mom and dad gifted shares of company stock to their daughter at a very young age. Daughter was not aware that this stock was there, okay? When she found out, and we talked about all these penalties, right? That's kind of where you start. So you go have a consultation with a tax attorney where you have privilege tied to those conversations. And you figure out a game plan, and then the attorney comes to me and says, okay, this is what we need to do. So we take care of all of those things. Knock on wood, statute has passed, to answer your question earlier, statute has passed on all of those previously filed returns. But she continues to get dividend payments on that stock. Initially, the company was withholding 30% tax when they distributed the dividend to her. And so she's like, okay, no problem. We had talked about it. I'll get a foreign tax credit. It's not a big deal. So we had to go back and look at the treaty. The treaty specifically says that the tax rate that you're going to pay, the withholding rate, is capped at 15%. Okay? So right away, we tell her this is the first year that she got a dividend on this, but it's pretty sizable. It's somewhere in the neighborhood of $50,000, $60,000 US. And so it's real money. It's worth going back and, have mom and dad go talk to whoever they need to at the company and show them the paperwork that says they can adjust it down to 15%. The kind of got you in that first year, they wouldn't pay it back to her. And our hands were tied on how much we could claim as a foreign tax credit that year, right? So there's a rule with foreign tax credit that it has to be actual tax that you are required to pay. So the first 15% of the 30 that she paid, she was required to pay under treaty. The second 15% was a voluntary tax, and we did not get to take the credit for it. But the good thing is we fixed it for the next year, and no problem since. Anyway, some kind of cool stuff. I get really excited about this stuff, y'all. Okay, let's go ahead and go to the next slide, and I promise this is it. Can somebody, yeah, thank you. So our takeaways. It doesn't say don't do it, right? It just says, you know, be aware of what you're signing up for. It still probably makes sense. Like, there's something in you that's driving you to live somewhere else for a while, right? Don't just discount that because I told you there's penalties and it's going to cost you more to get your tax return done and all that stuff. Don't let that stop you from doing what you feel is the right thing for you, right? But let's plan for it. Are you guys tired of this question yet? U.S. citizens living abroad get taxed on what? Man, you guys are awesome. All right, it's complicated, right? It's complicated, but it's doable.
But I like the next part of it.
Yes,
Mitigate double taxation.
yes, yes. Good planning allows you to mitigate as much tax liability or inefficiency as possible. And facts matter. It's not on here, but facts really do matter. Changing one little thing in the fact pattern changes how it's subject to tax, right? And let's not let that be that one little thing that changed, something that we could have seen coming, right? Let's make the plan and pivot as we need to. Know what you're getting into. All right, I'm going to leave you with this, and this is the penalty schedule, okay? Form 8865 and 5471, these are, you're invested in a foreign company and you forget to file the form. 10,000 or 20,000, depending on which category of filer you are. 8938, this is disclosing financial assets that you own over a certain amount, $10,000. FBAR 114, this is a bank account or investment account that you own or have signature authority over. That's the one that sometimes catches people. You can sign the account, might not be in your name. Failure to disclose that is, if you look it up, it says 10,000. But this one is adjusted for inflation, so we get to pay 16. Okay. 8621, this is that PFIC one, right? We're invested in a foreign mutual fund. We forget to file that form. No penalty for this one. Well, maybe. The statute on your tax return does not run. It stays open while that form is not filed. So it's important to make sure that you're filing it even though there's no penalty for not. 3520, that's the trust. It's also a $10,000 penalty. So anyway, there are mountains to climb when dealing with these things, but it is doable. I appreciate y'all's time.